Hello, and welcome to episode 7 of Onward, the Fundrise podcast, where you can find out more about what's happening at Fundrise and where you'll hear some in-depth conversations about big trends affecting the U.S. and the global economies. My name is Ben Miller. I am CEO and co-founder of Fundrise, and today's episode is being recorded on Wednesday, August 31st. My regular co-host, Cardiff Garcia, is out on vacation. So I'm flying solo with big shoes to fill without Cardiff, but we have a special episode in store for you today. We've brought on 2 guests for today's show, and then we'll have our regular investor Q&A with Kendall. So without further ado, I would like to introduce my guests today, who are some of the world's experts on technology companies, the hosts of the podcast Acquired, Ben Gilbert and David Rosenthal. Gentlemen, welcome to Onward.
It's great to be here. And I have to say that intro, Michael Barbaro, look out.
I was going to say we should start paying Ben to do the intro on Acquired.
Acquired, yeah.
I know. Yeah. This is great.
So Acquired, which is a show I listen to every time you guys put out an episode. It's one of the most in-depth, thoughtful podcasts in the world, in my opinion. And if you're interested in business and tech, it's my number one pick. So I'm really excited to have these guys on the show. So let me just tell you one thing that's different. Their shows are long form, 3 or 4 hours an episode, sometimes a few episodes for one company. So very in-depth on companies and the histories of the companies. And so my favorite episodes, Berkshire Hathaway, Sequoia Capital, and then Taiwan Semiconductors, aka TSMC, which for those of you who don't know the company, is partly why there's a flashpoint between the US and China about Taiwan. That's hard to believe that a company could be responsible for a potential war, but that's how important they are. So incredible. Can you share a little of your personal bios, just who you are, where you came from, your work, et cetera, before we get started?
Yeah, it's funny. David and I often describe our bios as going in reverse order. We're like ships crossing in the night. David starts in traditional finance and works its way through VC to founder and now amateur podcaster. And I'll let you give your more real bio.
Professional podcaster. We were amateurs for a while. It's the one thing I am professional at.
That's right. Amateur venture capitalist. You're a wonderful partner. And mine comes from the other direction. So did computer science undergrad, worked at Microsoft. I was an indie software developer for a while, producing early App Store apps when there was sort of a boom there and anybody with an idea could release something and get millions of downloads. So that was sort of a fun entrepreneurial experience for me in my early 20s. And post-Microsoft, I started working at Madrona Venture Group in their new labs corner office to play with new ideas inside the firm. I spun out of that with my colleague Greg Gottesman to start Pioneer Square Labs, which is a startup studio and now venture capital firm with a couple $100 million under management and 32 brand new startups that we have spun out of the studio itself.
Wow.
From software developer now to professional venture capitalist and podcaster.
There are a lot of things that make Acquired work to the extent it does, but it's so funny. Started as a practitioner of technology, as an iOS developer, working at Microsoft as a PM. And I came from the finance side. I started my career in investment banking, analyzing companies. And then I feel like we've just come full circle now that on Acquired, I do most of the sort of company storytelling and Ben does all the analysis. But yes, I mostly just work on Acquired these days. Like I said, it's the one thing I'm a professional at. I was a professional venture capitalist for over 10 years, most of that time at Madrona. And now I'm a non-professional venture capitalist. I have a fund on AngelList with my partner, Nat Manning. We manage about 20 million in LP capital, and we write kind of small checks into rounds alongside larger venture firms.
That's probably why I like you. You're no longer a professional venture
Yeah.
investor. So Acquired, I feel like it's still one of the best kept secrets in the Valley. Anybody who's deep inside knows about you, but I still feel like you're not widely known outside. So I'm excited to introduce you to our Fundrise listener. So I thought maybe it'd be a good opportunity to have you give a couple examples of some of your playbooks or stories so people can hear what you do, how you think, and better understand what you're about. The thought I had was to pick a couple of your favorite best practices, or if you want to pick a couple that you feel like are some of the best things you've seen that are just phenomenal, work really well. Give us an example.
So we did an episode kind of codifying our favorite learnings from a couple hundred companies now that we've covered on Acquired. And these are some of our favorites. So let your winners ride. I think this is a sort of truism in venture. We'd heard it coming up in the industry from a long time. The idea of hey, if something's going to succeed and become a true power law distribution winner, the odds that it continues, its successful trajectory at any moment in time are actually quite high. If something has been compounding for a while to get to a large number, it's actually kind of hard to interrupt that compounding. And so you should, quote unquote, let your winners ride.
And there are various points at which there's almost these like interesting inflection points of figuring out, well, is the compounding going to continue or is it about to start plateauing? And for these best companies in the world that we often unpack on the show, Amazon and Apple and Berkshire Hathaway, they reached escape velocity from the atmosphere where it was clear that these are big companies that are going to keep growing really fast unless you sort of make an unforced error.
So then in the course of doing the show, there was one moment in particular that was just so visceral that hit us of how powerful this lesson is and how absolutely terrible and tragic it is when you violate it as an investor and go against it. And that was Sequoia Capital's famous investment in then Apple Computer. So Sequoia Capital, one of the most, if not the most storied venture capital firm out there, really, I think you could argue in a lot of ways, invented modern venture capital the way it's practiced.
For sure.
And they and Don Valentine, its founder, were among the initial investors in Apple. So whenever it was when Apple was started, let's say 1977, Sequoia invested, and then they had an opportunity about 18 months later to sell their shares in Apple on the private market before the IPO at something that I want to say they invested $150K. I could get that number wrong in the company initially. And I think they had an opportunity to sell it for $6 million or so, I want to say.
Sounds about right.
Which the whole fund, remember, this was in the 70s. This was proto venture capital. The whole fund size was only 3 or 4 or 5 million. Yeah, maybe 5 million. So return the entire fund within 18 months of having made this investment. And so they did. They sold.
Because who wouldn't?
Before the IPO. Who wouldn't, lock in those gains, return your entire fund, send money back to your LPs.
Especially as an unproven fund manager. I mean, Don Valentine had been a very talented executive in the semiconductor industry before, but was sort of professionalizing as an investor, not just individually investing in companies himself, but managing outside capital for the first time. Pretty nice to have that early win and tell everyone who believed in you that they were right and give them their, nice return on their capital.
Send them cold, hard dollars back. Well, that was the most terrible, terrible error of judgment. It may have been the single biggest mistake in all of investing history.
Which is both a dunk, but it's also the thing that is required for that to be true is for the initial investment decision, the buy, to be one of the best decisions of all time because it is in a company that has the potential to get large enough such that selling these shares was the worst decision of all time. It's one of these errors of omission versus errors of commission type things. I've made plenty of bad decisions, but none of the companies that I've made bad decisions on have become as successful as Apple.
The intention here isn't to dunk on Sequoia because they got it right on the buy.
Also, they can take it. I'm happy to.
Yes, right. But the lesson is that in startups, in technology, in markets that are driven by power law and have exponential growth dynamics, the winners can get so big, bigger than you could ever imagine. And so selling early is absolutely not what you want to do.
I got to temper you, David. The reasons are these globally addressable market. The internet makes it possible to address the entire world. The cost structure of software with these unbelievably high gross margin businesses, the fact that you can have monopoly-like or actual monopoly behavior, it does allow for these unbelievably enormous companies. But Apple is certainly not a straight line of just compounding year over year over year for 30 years. And now they're a $2 trillion company. It would be overly simplistic to say, well, because the way that companies are built these days, you should always let your winners ride if they're going well. There are things that plateau too, but your winners come from letting the ones ride that go forever.
Here are 2 questions here. So one, what do you think was the total return if they'd stayed in? What's the magnitude? Just some estimate.
I don't know that I've ever seen what the valuation was on that first round, but I'm going to guess, given the time, that the total company valuation when Sequoia invested was probably $3 million, I would guess. What do you think, Ben?
I think that's right. And I think Apple IPO'd with a market cap of $1.8 billion, which had made it the largest IPO since Ford, which was 20 years prior.
That was in 1980. Yep.
So you can understand if you invested at that price that you just mentioned, that seed valuation, and it's worth 1.8 billion at IPO, you're like, yeah, I'm going to sell. But obviously selling at 1.8 billion when the company's worth 1.8 trillion.
Oh, if they had even only held till IPO, they would have made a lot more money.
Yeah.
They sold before the IPO. So I'm trying to think in percentage terms. If it was a $3 million valuation and they invested $150K. Oh yeah, so they own 5% of the company. Wow. They owned 5% of Apple. So if they had held until the IPO, they would have had 5% of 1.8 billion, which is a lot more than $6 million. But then if they had held till today, which obviously they wouldn't have, but like 5% of 2 trillion.
Yeah, 100 billion.
So I've never thought about it this way, but Apple has had 1,000x since their IPO. And I could be missing something and a little dilution that they were taking or additional capital they raised or something like that. But if they IPO'd for 1.8 billion and looking at what they're worth today is 1.8 trillion-ish, how many companies get 1,000x after the liquidity event?
Right, and almost like 100,000x from their seed.
Yeah.
Incredible. So, okay, well, here's my my other question. And we're big believers in long-term investing and the power of consistent compounding over time. One thing I can't help but observe when I look at the investment behavior of the venture industry is I feel like I see a different pattern, and that most venture firms sell to the public market and dump the stock. Maybe it's about the hype cycle, and there's a lot of critique of that, but why do you think their behavior is so inconsistent with one of these great lessons?
I think you just have to look at the entire universe of incentives around all the agents at play. So you have GPs, you have LPs, you have board members, you have relationships between all these entities. And so you sort of just look at what are the demands and incentives on any given agent in the system. And, a lot of the times there's a big incentive for GPs to realize liquidity and distribute that to LPs. That is the business that of venture capital, which is these 10-year funds. And the goal is to then hand back either cash or liquid securities to your LPs at the end or near the end or just after the end of the fund. Sometimes you can have these little extensions. I'll also say most of the time, most GPs at venture funds don't believe that it's the next Apple.
And most of the time they're right.
Yeah. They believe that, hey, it's awesome that it got this far and this is where we don't really play a huge role anymore. And there are great people to be on your board and there are great people to be public shareholders, but we don't view this part of the journey as our job. And that's, again, not always the case and everybody's different. In addition to the sort of incentives at play to realize liquidity for your LPs, you also definitely have would you fight harder to hold this thing in some way and keep generating profits off of its upside and take some risk on the downside if you thought that it was still an underpriced asset?
Yep. There's also one very important piece of nuance here that makes venture firm behavior a little less black and white, which is that most of the time when VCs, quote unquote, sell their stake in a public company, they're not actually selling.
Yeah.
They're distributing the shares out to their LPs and to the GPs. Now, there are rare cases, but it happens where a venture firm will decide, I actually want to engineer a block trade and like literally sell the shares that my firm owns, get cash, and then distribute the cash. That does happen, but that's quite rare. More often, the conversation goes something like this between the VCs and their LPs. Let's take Snowflake. Great example. Wildly successful IPO, very valuable company, great prospects ahead. They've now been public for 2 years, 3 years, I want to say? Something like that.
And a lot of different ways to look at this company. You could look at it and say, wow, they have the single highest multiple by price to sales of any other SaaS company in the market today. Or you could look at that and say, geez, this thing's undervalued because it's so much better than the competition and so revolutionary and changes the way that all data moves around companies that it's worth prices even higher than this at its current state.
Right. So right around probably starting about a year ago, a lot of the LPs and the venture funds that held the majority stake in Snowflake after the IPO started probably calling up the GPs and having conversations like this. I don't pay you guys to manage my public stock holdings. Why are you holding on to these shares? Distribute the shares and then let me either personally make my decision of what to do with them or give them over to the people on my team who are professional public equities managers. I don't like you keeping me locked up.
And either way, stop taking 20% of the upside from here.
Yeah.
Right. So just to kind of summarize, one, most importantly, it's structural, right? It's just fundamentally how they're organized, how they're incentivized, what their job is, both in terms of GPs, LPs, their incentive structure. So they do what basically they're designed to do. This is what their mission is, right? Their mandate. But at the same time, like the distinction between public and private markets, it's one that I think is starting to break down.
Yes, very much so.
And that's something we're all about. So I think that it could raise interesting questions. You're seeing it already as a lot of public investors became private investors, and I think private investors will become public investors. And so it's the beginning, I think, of how that might change.
Totally.
We would be remiss, though, if we wouldn't say that the new Fundrise Innovation Fund is, I think, going to play a big part in it's like this, at this point, ridiculous artificial distinction between a public and a private company. And there should be crossover products that allow people to invest across both of those. It's just so awesome what you guys are doing.
Yeah, well, that's obviously my opinion.
Our opinion too.
But I think it will become a broadly held opinion. And we just happen to be one of the first, if not the first. So, all right, let's do another one.
Great. This insight, when we put together this episode that we did, was just as the markets were cratering. And there was a lot of pessimism and doom and gloom out there. And we thought back to the episode we did on the Sony Corporation. Sony, everybody who knows, the great electronics manufacturer, maker of the PlayStation from Japan. And the Sony story, I love so many of the stories that we get to tell on Acquired, but the Sony one is just incredible.
It's maybe the best pure hero's journey. That or NVIDIA.
Akio Morita and Masaru Ibuka, the two co-founders of Sony, they were engineers in the Japanese military during World War II. And then after the war, they started Sony. Literally, they started Sony in 1945 in Tokyo. My favorite stat, Ben, you might remember it better than me, was something that the GDP per capita in Japan in 1945 was $17.
Yeah, $17 period, like a year. The other insane thing is that in Tokyo, it was almost exactly half of the population was homeless. Truly sad in all of the scope of humanity, one of our darkest hours as a people.
And these two dudes were like, we're going to start a consumer electronics company because we have hope for the future.
People can't buy food. And they're like, you know what? I bet radios. I bet people are going to be really excited about radios, which they were.
They were. And that company absolutely changed the world and was the direct inspiration for Steve Jobs and Apple and the iPod and everything. And so compared to that, we live in freaking great times. Totally. There is nothing wrong with the world today. And the point is that if you're a pessimist about things, you're not going to make outsized returns, because if you're betting that something's going to go down, the most it can go down to is zero. But if you're betting for things to get better, then you have infinite upside.
And it's probably worth understanding a little bit about, it wasn't just okay, then they started a radio company and then it was off to the races. They had several failed products. They thought they were going to be a services business first, repairing different things that were broken in the war. And they ended up hitting product market fit with this very early radio when people were really hungry for information. Obviously, it was a scary time when you weren't sure what the future of your government was and of your country. And the ability to reliably produce a device that people could have in their house and get reliable information about what's going on in the world is crazy valuable. And so it's just this tenacious story of entrepreneurship. There's many unprecedented things that we talk about on Acquired. One of them is when Amazon was first started, the internet the previous year had grown 2,300x from the previous year in terms of the amount of traffic that flowed through it. Nothing you can observe grows at 300x most of the time, 99.9% of the time in the world. And so it takes these crazy dislocations between existing markets and existing products and existing state of the world for this chasm to open up that the right sort of tenacious entrepreneurs can go in and rearrange the world the way that they see fit.
I love this one. They invented the Walkman, which probably many listeners don't remember having, but I had one. The CD player. Then they go into PlayStation, Sony Music, Sony Movies. So it really had a one thing after another of success and then a bunch of failures.
And they conglomerate. I'm going to use conglomerate as a word here. They conglomerate better than any other conglomerate ever has. There's a lot to hate about conglomerates, and there's a lot to rag on them, sort of the 80s era of business. But there's something really impressive about the fact that Sony has 6 different business units each of which has revenue and profits that represent a double-digit share of the entire enterprise's revenue and profits. So that is like a massively distributed...
It's a very equal-legged stool.
Yeah, like Google
Yes.
doesn't have that.
Right.
Okay, so here's my follow-up question about this one, because it's a little bit like what the winner's ride, right? Like Akio Morita and Steve Jobs are exceptions, but you have this sort of lesson that's like almost like a rule. Is this selection bias? Like, how do you think about...
Yes.
Yes, it is.
But
It's a great lesson for everybody.
No, but that's the point in venture. Like, I think that's the thing about particularly early stage technology investing and venture capital investing. And actually, I'll throw out another one because this is probably going to be a controversial point. This is based on some recent news, and we normally don't talk about recent news. But
Adam Newman.
Adam Newman raised $350 million from Andreessen Horowitz, which you could look at and have a lot of legitimate criticisms about diversity and how do people like this keep getting funded. You could have a lot of big open questions of like, did this guy run a gigantic multi-billion-dollar scam and get away with it? But the thing that you can't argue with is he is unbelievable at willing something into existence, which is the behavior of an outlier human. And what it's clear to me that Andreessen Horowitz did with this bet was they said, look, there's going to be a lot of crazy stuff that goes on here, but we know for sure that he can will something of mass scale into existence, start a movement, attract capital like no other human on the planet.
Elevate consciousness.
That already puts him in the 99.9th percentile of something. And so we only kind of want to be in business with people that might be a cratering hole in the ground, but might create something really, really huge. It's this asymmetric upside concept. And so I think like venture capital is the business of outliers. You are right. All of these things are exceptions, but that's kind of what you're supposed to be chasing. And that's why you have a portfolio.
Yeah. And, as a Series A, a very large Series A, benchmark Series A, WeWork, they still made 16, 20 times their money Benchmark did on WeWork.
So, yeah. Well, they got out at the peak too. They sold to SoftBank.
Benchmark knows how to sell also.
Yeah.
Being an early investor is not the same as being a late stage investor.
Totally different risk profile. Our early stage is like, go give me more of that tail risk. Like I want to gobble it all. I'll go more out on the extremes as I possibly can.
Yeah. Which we should caveat too. Like it would be a huge mistake to take these sort of like venture capital type company lessons and apply them to all companies.
Yes.
You talk about this a lot with Fundrise, your success being in large part due to the fact that you didn't take traditional venture capital, because the traditional venture capital playbook is like the steroid playbook. It's like we're playing for the exceptions. So we're going to pump you up to be as big as you can possibly get. And if you become an exception, you make everybody's entire financial lives forever. And if you don't, that's okay. We've got a portfolio.
And here, David, is where I would argue that Ben and Brandon and the team actually are those people that are 4 or 5 standard deviations out from the mean, because when they totally could have, they didn't raise venture capital and they had a very specific point of view about the company they wanted to build. I don't know.
Enough of that. So it does...
You're too humble.
It does make me wonder, as Fantasy Venture's gone from being this tiny business of a few $1 billion to being like almost, it's going to be $1 trillion soon, right? 600, 700 million.
Yep.
Like, does that model mainstream? No, right? It's a model of exception. So how do you mainstream $700 billion of venture, right? You can't.
Well, I think it's exactly the point that you guys are making with the Fundrise Innovation Fund, that it's just a shift from public investing to private investing. It's not like there's $700 billion getting deployed into seed stage companies. The vast majority of this is post-product market fit growth stage capital. That used to happen after the IPO. You look at Amazon's IPO or Apple's IPO, the companies just used to do a lot of that in the public market.
Amazon raised several $1 billion after the IPO. Today, that would be in the private markets.
Yeah. So I think the vast majority of this capital is not chasing tail risk. And so there's a clear bifurcation to me of people that realize they're in the early stage venture business and organize their whole fund around that, and other people that say, okay, we're going to call this venture capital, but we're all looking at each other knowing that's not what the risk reward profile looks like.
Yeah, but in essence, there's almost 1,000 unicorns worth over $1 trillion in the private markets. That's like more than half of the size of all the small cap public companies. I believe that those private companies backed by top venture funds are probably higher quality, higher growth, and yet you can't invest in them because of the private public market distinction. So our mission is going to be attacking this divide.
Sidebar here, but it's been a total net negative for society that this dynamic has played out over the last 20 years. Like Amazon IPO did a $438 million market cap. Retail could participate in the vast majority of the upside. And now, like what Uber went out at 70.
Wow, Amazon has 3,000x since its IPO that retail had access to.
I think Uber went out at 70 billion, if I'm remembering right, and is probably trading at or below 35 that now. Yeah. Wow. Yeah.
So we digressed here though. So I want to get to last playbook.
All right. So this last one is the Moritz corollary to Moore's law, and I like that it adds a little bit of justification to David's optimism always wins. So there's a well understood concept called Moore's law, which means that the number of transistors on a processor approximately doubles every 18 to 24 months. And when you do some more multiplication, what that kind of means is that you can get a 10x increase, which manifests in speed of processor most of the time, every 7 years or so. So every 7 years, chips are 10x faster than they used to be, the sort of next generation. And when you think about these and you just look at, just for some examples, in 1985, the Intel 386, and then the Intel 486, and the Pentium 4, and the Core 2 Duo, and the A7, and the M1, we went all the way from 275,000 transistors on the chip in the 386 in 1985 to the Apple M1, and of course now there's even an M2, but with 16 billion transistors on the chip. And so we all sort of like can observe this the way that this has become something true in the world. You just expect to be able to do way, way more interesting stuff with computers like pretty soon, all the time. But the interesting thing is to plot that and realize that it's this exponential increase that looks kind of the same way that really high-performing stocks look over 10 or 20 years, where you sort of have this chart that goes, it hockey sticks. It goes upper and to the right or way faster. So the interesting thing that we sort of did was let's overlay Moore's law on top of basically a graph of the total market cap of global tech equities. And they're exactly the same shape over exactly the same set of years. And this corollary that Michael Moritz of Sequoia really came up with is that cheaper compute, at the rate that compute gets cheaper, creates these larger markets, creates these addressable markets that then create bigger outcomes for companies. And the Sequoia partners have looked at each other at various points throughout their history, one of which was Cisco was in this unbelievable outcome.
Cisco was their first winner where they held. They let the winner ride.
And, they had seen small ball stuff before. Atari, Apple was a small company at the time, but that Cisco is a massive company. They looked at each other and they thought,
billions.
How could we ever do better than this? How could companies ever get bigger than this? And of course, now we have multi-trillion-dollar companies. And until reading this insight from Mike Moritz, never really put together that, massive companies in massive markets really is Moore's law at work.
It's totally, this is such a good point, and you can experience it viscerally when you think about it. The fact that today, anybody with a computer, including a smartphone, can make radio and or television content and distribute it on the internet for free. That's Moore's law.
To a billion people, which you never could have reached before.
20 or 30 years ago, that would have been wholly uneconomic to do that. But now it costs zero.
I think it's such an elegant explanation. Of course, market value gets bigger because Moore's law basically opening up more potential, because the more computing power is, the more things you can do, and the more valuable it becomes.
And then it gets cheaper and the more people can use it. Anybody can spin up OpenAI to do stuff today.
Right. Well, not anybody, but but I hear you.
Just about anybody.
Just about, yeah. So, okay. So that makes sense. But so I'm often a skeptic. So let me just try to ask a different way to think about this, which is how do you square this idea, Moritz's maxim, if you will, with the data that indicates that growth and productivity in the United States have been falling for the last 30 years. And so you have sort of exponentially higher market caps, but at the same time, you have falling productivity, falling U.S. national growth. So how do those two things square, do you think?
This is one of those deep paradoxes of our time, I think. Do you have a good answer, Ben?
I'm a little out of my depth here, but I would guess it's more in the geopolitical realm and thinking about the decisions that we in the U.S. have made as a country of what we want to invest in, what we want to do here as our core set of activities, and what we want to outsource. And I would guess this is more the result of the the natural second and third order effects of the things we've decided we're going to do and the things we've decided we want other people to do. But
one of the elements of the nature of technology and technology companies, for better or for worse, there are good things and there are bad things about it, is you can get incredible leverage out of the value that you create. So my favorite visceral example of this of all time is that Instagram, when it was acquired by Facebook, for the now seemingly quaint dollar amount of $1 billion, had 13 employees, including the founders. So 13 people got together. Half of those people had only just joined in the last 2 or 3 months, and they created $1 billion of value. That is because of the leverage of technology.
And in reality, what they created was $1 trillion of value, but it was bought for $1 billion.
Right. Yeah, Zuckerberg got a deal on that one. But that value accrued to 13 people that was created.
I won't go too much into this, but it should have shown up as growth. The distribution of growth is separate from the absolute amount of growth, right? It's just strange to me that you can have so much market cap growth, trillions, right? And yet US GDP growth has been slowing. It doesn't square for me either. I see change happening faster and faster, yet there seems to be decline in a lot of the things that matter. And as an investor, it matters to me to think about why is this happening, because it affects how I would invest.
How is GDP calculated versus how is enterprise value of a company calculated? Are they fundamentally two separate measures?
Yeah, I guess so. GDP is like a revenue.
How does GDP compare with corporate earnings?
You could say that GDP is more about flow and market cap is more about stock. There's another argument possibly that it's actually just falling interest rates the last 30 years. Because if you overlaid your graph on interest rates,
that would also be.
Isn't the answer to everything just interest rate policy? That's one of the very defeating, for anybody who's a strategic thinker and trying to analyze something. Too many times the answer is actually interest rate policy. And it just makes you you kind of want to ignore it because it's such a dominant factor in every piece of analysis, but you can't ignore it because it actually determines too much of our world.
Yeah, real estate investors know that. So
yes, you do.
I have a series of rapid fire questions. We could try to answer them. Okay, so we're launching a fund focused on private growth tech companies, Fundrise Innovation Fund, right? So the whole point of it is to let anyone invest in private tech. Two-part question. So do you think that there's retail demand for VC as an asset class? And if there is, why do you think that demand hasn't been met before now? Why are we first?
Regulatory capture. Not by you, by old incumbents.
I wish.
Yeah.
Those with good access to companies to this point have found it easier to raise from private qualified purchaser or capital pools rather than the public.
So it's just profitable enough that they need to innovate.
And it's new. It's different. Anytime you're doing something new and different, it's most people just don't ever have behavior change. So they're going to keep doing the other thing as long as it's profitable.
Yeah, well, the SEC put up guardrails with, I think, the good intention of protecting American consumers, but a unforeseen outcome of those guardrails that were started to get put up in the 20s, I think, in the 30s, after the stock market crash, was only the wealthiest people got access to the riskiest investments. And here we are.
And risk changed over 100 years. Yeah.
Yeah.
So you guys have been venture investors and made in-depth studies of hundreds of companies. So what do you think makes for a successful new venture fund? How does a new fund break out and achieve great outcomes?
Find outliers. Be in business with real legitimate weirdos. And it might go super, super wrong. So that's why you need a portfolio approach. But the surest way to have a fund 1, maybe a fund 2, and probably not a fund 3 is to invest in founders who are in the middle of a distribution.
I have a great quick story on this. So when I was a very young whippersnapper VC at Madrona, I got a chance on a board to intersect with and get to know a little bit Bill Gurley, a legendary investor from Benchmark. One day I got to meet him for drinks in San Francisco. And I was so excited. I literally had written down in my notebook, I planned for weeks. What are the things I'm going to ask the legendary Bill Gurley? And the top number one question I had, I was young, starting out in my career. I was like, what leads to success in venture? And I asked him this. It must have been so ridiculous. I was such a naive little kid. And he just looked at me and laughed. I was like, David, success in venture leads to success in venture. And I think that's the best answer. Success leads to success. If you have successful investments, you will become known for those and entrepreneurs will seek you out. And how you get your first success, there's a million ways to skin the cat, but that's on you to figure out. Like, you figure that out, you're good.
That's beautiful. Okay, so keeping the pace going here. So, okay, you've got plenty of boards and you've been around the table for lots of companies. So what percentage of VC investors have you seen really add value? And then, like, how differentiated is that value?
Oh, this is the hard-hitting question.
I got to be honest, most investors that I'm on boards with add value. Question is about net. Do they net add value?
They also take away value, you're saying?
Yeah, they add drag. Oh, can you prepare this report for me? Oh, my back of office needs this. Oh, can you please go talk to this person because it would be good for me, but it actually may not make the most sense for you. And as a VC, you really try to minimize those sorts of requests on founders. Truly believe most investors I have been on boards with have been very helpful to companies, which is a weird contrarian answer. And I'm supposed to shit on VCs here, but
no, that's a great answer.
I think the industry has progressed hugely in the last couple of years in that, for the most part, capital and advice have become unbundled. Not 100%, but it is now very possible at most stages to raise money without taking on board seats as part of that. And I think that is a good thing on net because it's an unbundling of two separate products. As a founder, you can get great advice and great board members that are right for you, independently of your capital providers.
Yeah, it's invisible to the company. It sort of reminds me of like merchant fees, like the consumer doesn't pay them.
Yep.
But the capital is paying 20% to the venture fund, 20% carried interest, 20% of the upside. And if you think about the math, the employees in a company are getting 20% employee stock pool. The typical stock pool of a company is less than 20%. So the venture fund, the guys that work at the venture fund, like the 5 people or 10 people who work there, getting the same amount of upside as the hundreds or thousands of employees. So when they add value, people just aren't putting like compared to what?
Yeah, right.
Right.
Sure, lots of people add value, but how much are you paying them for that?
Compared to, are they adding their worth?
Everything's about opportunity cost.
Right.
Okay, I'm going to try this. This may not work, so let's just try it. So ready to go. You guys know Tyler Cowen?
Of course.
Let me explain this to listeners who haven't heard of Tyler Cowen. He has this part in his podcast where he asks his guests if something's over or underrated by sort of popular opinion. So AI.
Machine learning is currently underrated.
Underrated?
Underrated.
Yeah.
Yes.
Yep, I agree with that. I think it is at a low point in the Gartner hype cycle right now.
All right. Okay, this is a fun one. Okay, ready? Being a founder-friendly VC.
Oh, appropriately rated.
Okay. Tesla.
Ooh.
Overrated. I mean, literally the stock is priced too high.
I'm going to go with underrated.
You believe that if you were to buy Tesla for its market cap today, you could eventually get cash flows out of it that would make it a profitable investment.
Well, I'm a shareholder, so my money is where my mouth is. I believe Tesla's gross margins are like double, triple the rest of the industry. So if you just play that up as they scale up, they'll be more profitable than the rest of the industry.
Okay, ready? Mark Andreessen.
Oh, wow. I'm going with appropriately rated.
I am too. Every time I listen to that guy talk, I get smarter.
My last one here. Crypto.
Underrated. Right now.
Right now, underrated and on a long time frame. I don't know what the hell it's going to do next week, but...
Last question here. So, okay, like tech bubble just collapsed. Do you have any kind of near-term outlook for tech and venture going into the next, let's say, 12 months?
No, anybody that ever professes to have a near-term outlook is just wrong or lying.
I have one.
I like it. Yes.
That's my tee up. My near-term outlook for venture is that it is a good time to invest in venture writ large and particularly early stage venture. And I would give that answer any year, regardless of the climate. I think it is always a good time to invest in early stage venture.
All right, gentlemen. Well, thank you very much for coming on. It's been awesome. You guys are so fun, so smart.
Thanks for having us. This is great.
Thanks, Ben.
So I think it's time to bring on Kendall Davis, Head of Investor Relations and Investor Operations, who's been waiting patiently with her payload of investor questions. So Kendall, let's get into it.
Hey, Ben. Thanks for having me back. Ben and David are so smart. I just love hearing from them. So we're going to switch gears and talk about real estate, though. Are you ready?
Yes.
All righty. We've got a question from Byron from Texas. He's worried about what's going on in the macroeconomic environment. So his question is, I am worried that maybe I'm a little bit late to the show as far as returns and capitalizing on what you all really do best. There's never a wrong time to invest. It just may not quite be as lucrative over the next 2 to 3 quarters. Do you still anticipate growth? Or maybe you need to get more surgical with your markets and what you're going after? Are you really focused on these hot areas, and when you cool off, you go in a different direction as well? So there's a lot packed into that question. Are we still anticipating growth? I think specifically in single family housing was his question. Is now a bad time to invest? And will we change what markets we're investing in over the short term? Is sort of how I would boil down that question. Curious on your thoughts, Ben.
Yeah, this is, I think, a really good question. One I think about a lot too. So I think you have to look at it from 2 perspectives, on the long term and the short term. We think build for rent is a 20-year trend. It's the birth of a new sector in real estate. Real estate back in the 90s, it was only really office, retail, apartments. Then over the last couple of decades, industrial became the most successful real estate investment. Data centers and cell tower REITs, which basically didn't even exist, were the best performing REITs of last decade. So these new trends actually are how you really make larger returns in real estate. And I think build for rent is replacing office. And so I'm optimistic over the next decade or 2 on this trend in the long term. So in the short term, though, that's very difficult to see because we're in a period of high volatility. Interest rates are rising because inflation's been higher than it's been in 40 years. So let me just address that with a couple points. So 1, interest rates and inflation are twins. They're paired and they rise and fall together. So inflation's been high, which basically means that the Fed has to raise interest rates to bring inflation down. And that inflation has been driving up real estate values. Our real estate values in particular have gone up. Last year, they went up 30-40%. So what's good about real estate is it's a hedge on inflation and it captures a lot of the value of inflation. So there are 2 ways you can make money in real estate: higher income from higher rents or higher sales price. And so the inflation is driving higher income and interest rates are lowering sales price. And so far, they've been balanced, or actually we've had more income growth than there's been lowering in asset price. If the Fed's successful in taming inflation, asset prices basically should go back up. So the asset prices is temporary, but rent growth is fairly permanent. So when I look at what's happening, basically we're getting a lot of rent growth, which is driving up values and should drive up values basically permanently. And asset prices may fall in the next 12 months, but I think of that as fairly temporary because after 12 months, 24 months, Fed will bring inflation down and we'll end up in a more normalized scenario where asset prices are more reasonable on a higher income base or higher income denominator. So I feel like all things considered, we're in a good situation.
So even in situations where you are in a recession, people still need somewhere to live. So going back to our thesis of sort of the financial economy versus the real economy, at least the types of investments that we've made would ostensibly do well, even in a recessionary environment when you're dealing with things like housing, in your opinion?
I mean, there are definitely scenarios where nothing does well, right? You're talking about high interest rates, slowing economy, high unemployment. You probably have a liquidity crisis because the Fed's currently selling down their balance sheet. It's called quantitative tightening. So they're pulling liquidity out of the market. So there's a situation where everything goes wrong, which happened in March 2020. And there's also war in Eastern Europe. So it's really a question of people's risk tolerance. And I always tell people, if you're worried about investing, then don't invest. I hate the idea of somebody investing and losing money. I hate it. That's why I'm particularly risk averse. And so if somebody's worried, they shouldn't do it. But the problem is that for the next 12, 18 months, it's impossible to know what's going to happen. And there's scenarios where inflation comes down from 8% to 4%, but interest rates come down too. And actually, inflation continues to be a little higher than interest rates, right? Like that's a scenario, I think, a middle way where you have inflation fall and that allows the Fed to lower interest rates, but it still keeps inflation or rent growth above interest rates. So as long as rent growth is above interest rates, real estate's a great place to be. We said in our January letter that we thought this was going to happen, and it's played out close to what we predicted, which is basically the Fed was going to have to come at this much harder, tighten interest rates for longer, and that meant that asset prices would fall from the beginning of the year, and they have, and they're falling again. And so we went to the sidelines back in January, and we really slowed down investing. and we stopped bidding on new deals and we started building up a lot of cash. So we built up more than $500 million of dry powder. And we now, I think, have finally passed the point where the market's realizing that interest rates are going to stay higher for longer. And we started investing it. We started coming back in the market and we're going to invest it in a lot of credit. So we are operating opportunistically based on our view. And I think that will help capture some of the upside from the disruption that's going to go on through this year.
Okay, so last question. We've been getting a lot of questions lately about climate change. And this is another one that I really liked because I think it focuses on how we are trying to be more thoughtful about the home building that we are supporting, right? As far as the build for rent portfolio, Clarence from New Hampshire wants to know, does your home building include any aspects regarding climate change?
Yeah, that's a great question. Climate change is one of those mega trends that's going to have huge effects over the long term, but uncertain effects over the short term. Build for rent means we're building new homes. New homes have huge benefits over existing or status quo housing, especially what the institutions do, which is single family rental. They buy homes from the 80s and renovate them. A home from the 80s is nothing like a home built in 2021. There's been a lot of advance in technology for home building, like the materials, insulation. And so what we found, our homes are much more energy efficient, approximately twice as energy efficient as the average American home. That means not only like benefits climate change, but also the home is a much lower cost to operate. So I think we save something like $600 a year in energy costs because they're better built. The other thing most people don't know is in addition to energy, gas stoves are a huge source of methane. They're responsible for equivalent of 500,000 cars of gas. Even when they're off, they're actually leaking. And so we build all our homes with electric. And electric is, in the long term, much more sustainable and safer for human health and for fires, et cetera. Gas and energy savings are the two most important parts of making homes better for the environment and, as it turns out, better for operations, lower cost. So those are the two biggest things we're doing. We also, every time we buy a home or build a home, we put in a team that goes in there and puts in smart technology, smart thermostats. We are investing in smart technology so that our homes can operate better. So it's been a big part of our execution. It's kind of in the weeds in how we think about what appliances to use and how we spec homes. It's one of the reasons we like build for rent is that as a long-term owner, we can actually make the home much more suited for us. So owning thousands of homes is giving us more and more knowledge and more scale to actually make, I think, a better product.
Yeah, I mean, even without getting too technical, it makes a ton of sense. My house was built in 1940. I'm in my basement right now. I'm freezing. If you're 2 floors up, you're so hot, right? Like we've got really old windows. I think it's something that you don't need to know a lot about the technology to just intuitively understand that old houses tend to have these sort of, leaky windows. And there's so much new technology, I know, in the insulating techniques and multi-pane windows, really even in the last decade or so. So I know those are all things that we're consciously thinking about every time we're going through this process. But these are things that I think a lot of people don't think about in their day-to-day lives.
The reality is most people who own a home don't know anything about the technology inside a home. So we have teams of people who know all about that, and we have specialists and capabilities that just don't exist for individuals. So we can actually build and manage and upgrade homes in ways that no one else really can, except for a handful of big companies like Honeywell. So I think it's got a lot of potential for how to do even more later once we get a little bigger.
Efficiencies of scale. Thank you, Ben. Really appreciate you taking the time to answer these investor questions. I know our investors do too, and we'll look forward to catching up with more next time. So please, for all of you listening, email us questions at contact@fundrise.com. Make sure we get Ben the hardest questions. So the harder, the better. Thanks again, Ben.
Thanks, Kendall. And this is it for this Onward episode, the Fundrise podcast, featuring David Rosenthal and Ben Gilbert of the Acquired podcast, and Kendall Davis, head of investor relations and investor operations. My name is Ben Miller, CEO of Fundrise. We invite you again to please send your comments and questions to onward@fundrise.com. And if you like what you heard, rate and review us on Apple Podcasts, and be sure to follow us wherever you listen to podcasts. This podcast was produced by Seaplane Armada, who also did our music. Thank you so much for listening, and we'll see you next time.